So welcome in our next guest. Joining us now, Ted Thatcher, president over at Bright Lake Wealth Management. Ted, great to have you back on the show. Now, the rally continues. The Russell a little bit left out this morning, but we're seeing this sort of unstoppable rally despite what looks like we might have a higher inflation picture. We've got higher rates. What's really driving the power behind this?
Yeah, it's really interesting, Marla. If you look just at the indices, you would think, okay, everything has been all, sunshine and rainbows most of the year. But obviously, so much of it, if you look under the hood, the Mag 7 names, which have actually done well this morning so far, have really been laggards. The breadth and depth of the market, as has been widely cited, has really pushed the market this year. Obviously, the AI trade as well. But I remember when we were talking coming into 2026, what were some of the key themes we were anticipating? It came down to the fundamental earnings that we've seen. And obviously, that was the story of Q1. One thing that's performed very well, of course, is the equal weighted S&P RSP ticker, outperforming the, of course, cap weighted index by over 2% positive in the RSP side, down about 2.5% over the last 30 days on the cap weighted side. And so what's driving it right now is the breadth and depth of the markets.
And so with earnings being such a big contributor to this move to the upside, what's your expectation for this earnings season that we're about to start? I mean, we're in a little bit of the lull here, but once we come out of next week, we'll be right back in prime earnings season.
Yeah, absolutely. I mean, obviously, you key in on the consumer here. So much has been made of the pressure consumers have been under. Obviously, the Michigan report came out Friday, a little better than has been the case. But the truth is when I look at the consumer, I want to not just see what they're saying. I want to see what they're doing. And the retail sales numbers have been strong. Consumer spending, PCE, obviously, all have been really good, actually. And so I don't anticipate that to change very much. We might not have the banner type of quarter as we had in Q1. But I do still think we'll see some strong earnings in Q2, Q3. Obviously this summer, I will say I do anticipate some chop, especially coming out of, Chairman Warsh's first meeting and kind of settling the markets down, not jumping to that dovish conclusion that I think a lot of investors were actually anticipating from his first meeting.
All right, so for watching the consumer as we go into earnings season, what about AI and this conversation about bubbles? I mean, I think Micron sort of pushed some of those conversations a little bit farther down the road with their earnings, but how are you looking at that space as we come into earnings, and do you have any bubble concerns?
I think some of the bubble fears, I can appreciate having, a reasonable approach and having investors be cautious. And very much I think that that's an important thing with any investor strategy. But fundamentally, the AI trade has come down to the suppliers versus the spenders. The hyperscalers haven't performed very well this year. The market's been punishing them fundamentally because, basically their earnings are down. They're concerned about how much they're spending. Are we overspending? Why? Well, when you look at the other side of the coin, these suppliers, the gross margin seems to have no limits. I think, Micron came in above 85% gross margins. But the reason that I think that there's still a trade here and why it will continue, to be a positive one, of course, we might get some cyclical pullbacks here and there that are normal and healthy in the marketplace. But what's so interesting about the CapEx spend, so much has been made of, the headline number, $750 billion this year, over $1 trillion next year, $11 trillion between now and 2030. What's really interesting, and I think perhaps a little bit underreported on a company like Micron, is just how important the bottleneck of DRAM is, and specifically HBM, high bandwidth memory. There's only about 3 companies in the world that can create those kind of chips to build out these data centers. It's Micron, it's SK Hynix, and Samsung. And so when you look at next year specifically, 30 to 40% of that CapEx is expected to focus on that bottleneck. And so that is why I think that the bubble fears do have another side of the coin, another side of the story, if you will, to tell.
So as we look at that, and you say that part of the narrative is underappreciated, then where are you looking in the ecosystem right now to see the greatest benefit?
Sure. Yeah. I mean, again, I think depending on how you were looking at investing, right? Maybe if it's short term, I do think the suppliers have upside here. Certainly that would, and Micron would fit into that category. Even in NVIDIA with the forward earnings that it's trading at seeming, depressed, obviously they have all the pressure from so many of the hedge funds that are betting against them to do their hedging. But fundamentally, I like those plays. Again, the suppliers. On a long-term view, though, it's hard for me not to look at those hyperscaler names that have been kind of beaten down a little bit the last month and a half. The Amazons of the world, the Microsofts of the world, that Amazon. These valuations, if you look at the historical averages, are really, again, beaten down. And so I think that there's some opportunity there if investors want to have a long-term perspective.
So as investors are trying to position with this backdrop that we have, and you called it interesting at the beginning of our talk. I hear that word a lot: unique, uncertain, cautiously optimistic. I mean, there's a lot of tentative language in whatever the description is when I'm having conversations about trying to build out your portfolio and what the market looks like right now and how sustainable it all is. You talk about building a durable portfolio as opposed to trying to just outright beat the S&P. What does that look like in practice, Ted?
Yeah, we talked about the breadth of the market here. Fundamentally, one reason I like that a lot is because it's a diversification, inherent in that statement. When you talk about the breadth of the market, we're getting good earnings across, many, many sectors. And so I think fundamentally we have to come there. And I think that the reason you hear a lot of the hesitation in general, Marley, comes down to the fact that we've gone through this rally and nobody wants to sort of call the top, but they also don't want people to get into a dangerous situation. So much of who we talk to is, consumers, retail investors. And so retail investors, if we're not careful, can get caught up in some of the FOMO. And FOMO is not an investment strategy. Trying to chase it isn't an investment strategy. Systematic investing is what we recommend. So, when we have a big rally, if investors are a little bit concerned about, potentially being overpriced in any sector, I would say, use a 30-40-30 approach. Start with, 30% of what you want to get into the market. Pick a time frame, 3 months, 6 months, a year. Halfway through, add 40%, and then at the end, add another 30.
And do international equities have any part in a durable portfolio right now?
Yeah, I believe that they do. Obviously, so much. There was a big rotation trade at the end of 2025, 2026, beginning that so much of the international stocks were actually outperforming some of the U.S. domestic stocks. And so fundamentally, I think that they have a place in a portfolio. Traditionally, I haven't been a huge proponent of more than 10, 15% in a portfolio, but depending on what sectors and how you're coming at it, obviously we talked about memory today. I think it has a place for sure.
Ted, really appreciate you being with us. Always appreciate your insight joining us for the show. Ted Thatcher, President, Bright Lake Wealth Management.